We're gonna do chapter 6 handout, and I'll assign a couple of homework problems. We might just do them right now if you want to, but if you don't want to, that's fine too. But anyway, yeah, so we're gonna start out with tonight. Yeah, way too much stuff here on the screen. Okay. Nope, that's not it. Okay, and 6 is about foreign currency transactions, and chapter 7 is translating foreign currency financial statements, translating those into US dollars. And both of those are chapters we could spend a whole lot of time on, but we're gonna hit the stuff I think we need. Okay. We talked about this, I think the first or second day of class, but the foreign exchange rates. And they come in two forms, direct quotes and the indirect quotes. Direct quotes are the US dollar equivalents. So down here we have a US dollar. And it would take, well, it's about the same. It would take 0.85 British pounds for $1. Okay, so those are directly related to $1. We also have the indirect ones, and these are the ones we're actually going to use a little bit more in this chapter anyways. And the indirect quotes are currency per US dollar. So let's take one that's a little bit wacky. Let's go to this one, Australian dollar. It takes 1.45 Australian dollars to equal 1 US dollar. And then the question becomes, well, how much is 1 Australian dollar worth in US dollars? And you can calculate this by, if you have one rate, you can get the other one just by putting 1 over the top of it. So 1 divided by 1.5. Whatever that equals. Point 6878885. Okay. So that's how they came up with that. So let's take 1 over it. So let's go up here and figure out the British pounds. We'll take 1 divided by that. Turn my light on here. So it would take $1.17 something like that. You may want to check my calculations. You probably already know that, but sometimes they aren't great. So all you got to do is put 1 over it to get the 66797. Okay, I think that's it. And I mean, luckily, it's the same thing. You just use reciprocal. So the same thing going the other way. So if it takes $1.03 to buy a Swiss franc, well, take one. I'm going to copy it. It's likely to make a mistake that way. Okay. 'Last but not least, wrong. Eight, 5, 4, 8, 5, 5. Okay, I think that's it. So it's just a reciprocal of it. Now, again, we generally are going to be using this, the indirect one, because they're going to be paying us, or we're going to be paying in a foreign currency. And we have to know how many dollars we have to pay for those. So this will tell us, like, for instance, if we need a Malaysian ringgit, I'm not sure how you pronounce that. But anyway, it would take us about 22 cents for each one. So if you owe them 10,000 of these, you just multiply by 10,000. These rates change daily, so it's kind of a moving target, which brings us to the problems you can have, because you might, if you're doing transactions in foreign currencies, it's quite possible that you will have some kind of a risk there, because if the prices change, obviously, if the pound changes compared to the dollar, it can change this, and then you may have to pay more or less dollars to settle the deal. Okay, a few different definitions here. Spot rates are on the spot. What's the rate for purchasing something in a foreign currency today? Forward rates are in the future. So they have a forward rate, by the month and all that kind of stuff throughout the year, and they may go up or down. The big differences between them are the interest rates. Interest rates in different countries will drive whether the exchange rates go up or whether they go down. So if the foreign interest rates are lower than in the US, we have to pay more for their currency, because their currency is more secure, it's going to hold more of its value. If foreign interest rates are higher than the U.S., then it's going to discount. As time goes by, how high of interest rates they have, they may very well have a discount because of the interest rates. Their dollars are worth less going into the future. Or not, I shouldn't say their dollars. Their currency is worth less going into the future. And for whatever reason, most currencies of the world, they peg themselves against the US. Now, that doesn't mean you can't figure out what it is. For instance, if you were, if you had Swiss francs and you were buying Australian dollars, you could do the calculations here, divide it and figure out how many dollars it would take in Australian based on the US dollar. There used to be some timing delays in the markets updating, and they used to have traders that would trade hundreds of millions of dollars on the exchange rates, because sometimes you could, trade into Swiss francs, change the Swiss francs into Australian dollars back into US dollars, and make a profit. It's a lot tighter than that today, though. They might still do it. I don't know. Okay. So transaction exposure. So this is what we're really going to spend some time on. Hopefully this will be a shorter class, but we'll see. Okay. And the first thing we're going to talk about are the sales. If you export something. Now, if you export something and you're going to receive the payment in US dollars, there's no problem. Then it's just like a US sale. So if they're going to pay you in US dollars, it doesn't matter. You're not going to have any foreign exchange risk. You use US dollars, they use US dollars. Only when it is in a foreign currency are you going to have foreign exchange risk, because the value of the whatever their currency is could change how many US dollars you get. Okay. So let's do the first one. The Jack's company made a sale to an Australian buyer for 100,000 Australian dollars. Okay, so Jack sold in Australia. The Australian buyer wanted to pay 10,000 Australian dollars, and apparently Jack thought that was okay. So the sale was made on 3/1/23. At the time of the sale, the exchange rate was 70 cents per 1 Australian dollar. So the US dollar, 1 Australian dollar was worth 70 cents. Okay, so we have to put, I'll put the accounts on the books. So we're going to have an accounts receivable. Asset going up for some amount. And we're going to have a sale or revenue. I'll say sales. Not sales, revenue, just to cover all the bases for some credit amount. Now the question is, though, what do we put in here? We can't put in 10,000 Australian dollars. Our books aren't in Australian dollars; they're in US dollars. So what is going to be the value of the sale in US dollars?
Is it 7,000?
Yep. So $7,000. So they're going to give us a little more room here. That made it work. Okay. 10,000 Australian dollars times, those are worth 70 cents in US dollars. So that'll be $7,000. Oops. What do you do here? Okay. So we're gonna debit $7,000. And credit 7,000. So we're gonna have a sales of 7,000 and accounts receivable. At the time of the sale, it's 70 cents. And by the way, if you're wondering why we're using that, it oftentimes that is the best estimate of what it is. Whatever it is today is the best estimate of the value of it. You know, will it go up and down? Yeah, probably a little bit, but that's the best estimate. Okay. So, April 1st, the Australian dollars were received by Jack Company at the time the Australian dollars received an exchange rate of 0.67. Okay. So what was the value of the receipt in US dollars? You know, it's the same thing as up here, except you can bold that whole thing. Yeah, 6,700. Oh, I'm sorry, let me let me update this. Yeah, so this will be $6,700 is what it's worth when we get the money. So that's how much cash we got out of this, or whoever, Jack, that's how much cash Jack's got out of it. Okay, so this is how much cash we're gonna get back, is we're gonna have. Okay, so coming down here. Let's see, we gotta take this accounts receivable off the books for 7,000 because they just paid it. I'll put it down here. Accounts receivable, it's an asset going down. It was an asset, but now they just paid it. We're getting cash for the asset. So we're gonna get, so we're gonna take this off at 7,000. We're getting cash. 6,700. So cash is an asset going up. Ruh-roh, they don't balance. Let me ask you this. We were supposed to get 7,000, we got 6,700 for this. Now notice they, it isn't like they didn't pay us the whole amount. They said they're gonna pay us in Australian dollars and they did. So it isn't that they didn't pay it all. So we're gonna have a foreign currency translation gain or loss. Would it be a gain or a loss in this case?
A loss.
Yep, good. Yeah, we thought we were gonna get 7,000, but we only got 6,700. And again, it had nothing to do with what, the buyer paid us exactly what they were supposed to. But they paid it in Australian dollars and it was having to be worth less. So this will be a, oops. Translation loss. I could probably put foreign currency translation loss, but it's a little bit wordy. But translation loss is fine. Oh, what am I doing? Okay, and which statement would that occur on? And I've lost one of my statements. There we go. Well, it didn't matter. It goes on the first one. Yeah, we'll go on the income statement. So in the income statement, we'll have all our regular sales minus expenses and all that kind of stuff. And then there will be a other revenues and expenses, and there'll be translation loss will be in there. Question there? Okay, I will be quiet and see if you can figure out. Oops. The second one, very similar. I think that should be plural. Eons. By the way, I put sales revenue. You can put one or the other if you wanted. They're exactly the same thing. I think that should be. Yeah, what's the journal entry gonna be for the receipt of the 50,000 yuans?
Would it be cash 75,000, translation gain 1,500, or not 75,000, 7,500, and then accounts receivable 9,000?
Close. The accounts receivable is gonna be whatever we put it on the books for, so I'd be saying 500, but the 9,000 will be,
Okay, so I switched them.
yeah, exactly, so cash will be the 9,000. And you're right, it'll be a gain. Yeah, it probably should be called foreign currency translation gain, but we know what this is. And then we'll just take the, so this one's gonna come off, this one's gonna come off, it's gonna come off at the same as we put it on. So they no longer owe us the 7,500. And yeah, and that balances. Okay. So the foreign this will be the same as that one. So the foreign currency translation, it could be a gain, it could be a loss. It just depends on which way the currency goes. And sometimes I think I told you this before, but sometimes governments manipulate currencies for economic reasons. I know it sounds funny, but somebody will say, well, you know, the US dollar is strong. Is that a good thing or a bad thing? Well, it depends if you're buying or if you're selling. If you're buying, it's a good thing. If you're trying to sell something, it's bad. Yeah, and that's why a lot of companies that are developing or they want to, you know, increase their exports, they keep devaluing their currency. Why? Because they want to make their stuff cheap. You know, I don't mean quality cheap, I mean less expensive than, you know, than relative to the other countries. They keep devaluing their money. How do they devalue it? They print more. So, you know, sometimes it's actually an economic thing that they want to export more. And if you do that, you devalue your currency. If you want to buy more stuff, you know, try to increase the value, make your currency stronger. Okay. Problem 4, I think, is a year end stuck in the middle. Yeah. All right, so it starts out exactly the same as the other ones. $8,000. Okay. Okay, so this is just like we did before. So we put accounts receivable on our books as an asset going up by 15,000. And then we have sales or revenue or both. $50,000. Okay. Okay, now here's the new one. Year end comes around, you gotta make your financial statements. Okay, and you have these 20,000 Australian dollars that you are going to collect. The exchange rate is now changed to that. So the question is, how is that going to change what we are owed? So we're owed 20,000 Australian dollars times 0.77. It's not equal 15,000. 20,000. Um, 15,400. Well, what are we gonna do with that? Now, notice they haven't sent us the money yet. So we're not gonna get cash for that. They haven't sent us the Australian dollars yet. Let me ask you this, is it gonna be a gain or a loss?
Would you increase both the accounts receivable and the sales revenue by the difference of 400?
Yes, you would, that's exactly right. Now, this accounts receivable has actually gone up by $400, just like you said. Oops, these are in dollars. Okay, right. Okay, minus 15,000. Okay. So this is the amount that we are going to have to increase our accounts receivable by. And is this a good thing or a bad thing? Is this a gain or a loss? We thought we were gonna get 15,000 at year end. It looks like we're gonna get 15,400. So is that good or bad?
That's a gain.
Yep, very good. So we'll have a oops, 400. Very good. Now, again, notice at year end, we did not get any cash yet. Now, I know our best estimate though is that we're going to that it was worth $400 more. the currency. Okay, coming down here. The exchange rate jumps up to 80 cents. At 16,000. Okay, it is. All right. So this is how much cash we're getting. Oh, I put this in the wrong spot. Compared to the other ones anyways. Okay, so what are the journal entries going to look like? And be careful, because we have that accounts receivable, we have this accounts receivable, those are the same accounts receivable. We got to take off the books. So what's the journal entry going to look like? I'll put an easy one. We're gonna get cash of 16,000. You know, we're gonna take these 20,000 Australian dollars. We're gonna cash them in at 80 cents each and get 16,000. What are the credits gonna be?
Would the credits be a translation gain of 600 and an accounts receivable of 15,400?
That's exactly right. Translation gain is 600. You might say, well, wait, why isn't it 1,000? Well, remember, we already have this translation gain up here, right? So this translation gain is, 400 of it's already recognized, so this will be the other 600 of the 1,000 gain. And then how much we have on the book for accounts receivable? We have 15,000 plus the 400. And it all has to come off. Yes, it's going down because they just paid us. Even though it's going down, it's not a bad thing. We'd rather have the cash anyways. So this will be 15,000. Just like you said, this is 15,000. Oh, I should have made them green. I think the ones up there are. Hardest thing about accounting is the color coordinating. Ugh. Oh, let's get it wrong. All right, question on that? Yeah, let's do another one. And I think I'll be quiet as I can be, and see if you guys can do this one. Again, I think the Yuans are plural in that. This one shouldn't be plural. This is one Yuan. Who wrote this stupid thing anyway? But what would be the journal entry on for B?
Would you debit sales by 2,000 and credit accounts receivable by 2,000?
Close. The accounts receivable is right. Yeah, the accounts receivable is gonna go down by 2,000. Because it's valued at 15,000 rather than 17,000. The Oops. But now notice that the reduction here is not due to the sales, actually. It's due to what? The translation. So we're gonna call this a translation loss. Of 2,000. Now, what you said is absolutely right, though, in that if you look at our income statement, the sales would be 17,000. The translation loss is 2. If you were to do that, your income would be correct. But they like to break that out separately so that they know that, look, this loss didn't come from some failed, doing or something like that. It came from a translation. So they try to keep those separate. But what you said would absolutely come out. Your income would be exactly the same if you took it out of sales. Because this will be subtracted from, the sales revenue when you do your income statement. So translation loss, and again, so we thought we were going to get 17,000, but we're only going to get 15,000. Wow, can't see it. Okay. Okay, so coming down here. Jumped up to 18,000. Okay, so when we actually get paid for this, we'll get the 100,000 Chinese yuans, and we will immediately cash those in for US dollars. We'll get 18,000 out of it. Okay, now what is the journal entry going to look like for it? Now remember, the ones that are always difficult are the accounts receivable, because these, take these off completely off the books. You want to have a go at it? I'll do the easy one. Oh, I did the easy one wrong. That's why I was doing the easy one. So. Okay, so we have cash of 18,000 that we're going to get in. We're going to take those 100,000 yuan immediately, translate those into US dollars. After these first two journal entries, how much is left in our accounts receivable?
$15,000.
Yep. We have to take those off the books. Oops. And we have a $3,000 credit to make this thing balance. What's the account gonna be?
Translation gain.
Yep, very good, very good. Translation gain, and by the way, you'll notice something here that, gains are credits. And so our revenues are credits, so these all add to income, so that'll add to income. Loss will take away from it, this will add in. And if you're wondering why it's 3,000, well, it's because we showed a loss up here of 2. You say, well, wait a minute, this is 17 would be like 1,000, but actually because we recognize this loss of 2, it's sort of like it rebounded. It rebounded from the 0.15 to 18, so that it went from 15 to 18. That's why we recognize that whole 3,000. Another way to look at this gain would be that it was, the change was 3 cents times. I'm just gonna make it confusing. It was 3 cents times 20,000. No, that's not right. 100,000. So 3 cents times 100,000. Okay. Let's stop right here. Take a break. We'll say B. Back at 657. Let's make it 707. Okay. Okay, let's go ahead and get started. So we'll finish up the handout with addition. 10, 50 minutes. And then if you want, we can go ahead and get started on the textbook problems, but I want to make sure that the textbook problems I have are the same as the ones that you have. So anyway, let's go ahead and finish up the handout and then we'll go on. Okay. Purchases. So this is when we're buying something from somebody else. And maybe they don't want US dollars. So, they want it in their own currency. And so we agree to for the purchase, but now we have to pay in their currency. So that's what this one's about. This is sort of about purchases. This is sort of the other way around, where we have to pay them in their in their local currency, whatever it is. Okay. So purchase some equipment. Or we have a rupee is 0.022 $. Okay. So kind of like we just got to get a value for this. So 0.022. $11,000. The heck did I just do? Okay. So this equipment we bought, we have in the books for 11,000. Okay. So we're purchasing this, so our equipment will go up. Okay, now notice that we, the other party doesn't owe us, we owe them. We bought equipment from them, so we're gonna have to pay them in the future. So what kind of account are we gonna have here? So we have equipment, we have the asset. What kind of account's gonna go on the other side, do you think?
Accounts payable.
Yep. Accounts payable, it's a liability going up. We owe them more now. $11,000 more to be exact. So our assets go up, but so do our liabilities. We now owe 11,000 more than we owed before we got this. Okay. Come down here, we have to pay them and we have to take our dollars and go buy $500,000 in Indian rupees. The exchange rate now is 0.25. That's wrong. Change this. It's an absurd number. Change it to 0.025. Make sure you change this one. This is that would be an increase in value by 12 times or something. So I'm sorry, change that to 0.025. Yeah. Okay, so whatever that is. 12,500. So make sure you make this a change here. Okay, so we have to send them cash of. Well, actually, we're not sending them cash. We're using our cash to buy the rupees and then sending them the rupees. All right. What's going to be on the other side here? This is making all kinds of mistakes. It's an asset going down. So we're paying out cash of 12,500. We're using it to buy 500,000 rupees so that we can pay off our bill. So what are we going to have in the journal entry down here? We know we're paying out the cash.
Would you debit accounts payable by 11,000?
Yep. Accounts payable, it's a liability. When it's going down, we're paying it. We don't owe them anymore. This 11,000. Row, they don't balance. So we need a debit of 2,500. Oops. What account? I'll do the easy half. Translation, is this going to be a translation loss or translation gain?
Would this be a loss?
Yep, good.
Also, is it 2,500 in loss or is it 1,500?
I was testing you guys, and yeah, you're absolutely right. 1,500. I made like 5 mistakes on this one. This isn't my best one. Yeah, so yeah, you're absolutely right. 1,500 would be the lost translation. Oops. Okay, and we have one more. Let me go through here and make sure I didn't make any stupid mistakes. I did. Okay, we got another correction here. I was so careful with this one because it is wacky. Okay, let's see here. I gotta make a correction for. Okay, okay. This should also be a C, not a. I should just start over on this one. Okay. So go ahead and get so you can get started on that. And I'll have all the corrections done and by the end of class here sometime. And also change that to B. Say seller too. I gotta redo this one. What I was thinking. Okay. Okay, so we owe them 24,000 on the first one here. Down here, the exchange rate is 21. But the Indian rupees have not yet been paid. So what are we gonna do with that one? So we can now buy the rupees for 21,000. which by the way, is just as a, you know, as a planning kind of thing. If something like this does happen in real life where you're gotta pay in rupees and the price of the rupees really drops down, you may just want to jump on it and hit, you know, buy those ahead of time. There's nothing wrong with doing that to lock it in. But let's say you don't do that. What are you gonna do with this one?
Would you debit accounts payable by 3,000 and credit translation gain by 3,000?
Yep, exactly. Okay, so there's a liability going down. We owe them 3,000 less in dollars. Okay, but make sure you do this correction down here. So you 0.020. Okay, and the translation here is really working in our favor. So the payment obligation is 20,000. So we're gonna take $20,000 and we're gonna go buy 1,000,000 rupees with it. So our cash, oops. $20,000, we went and bought the 1,000,000 rupees. What's gonna be on the rest of it? Now be careful with the accounts payable because we had 24,000 accounts payable liability. We knocked it down by 3,000. So what there's 21,000. So we gotta take that off the books. Uh-oh, don't match. So what do we need? So we just,
Credit translation gain by 1,000.
yes, good. Yeah, so we just settled a $21,000 debt for 20,000, so that's gonna be a gain. For 1,000. Okay, yeah, so this is. You know what happens when you're dealing in the local currency or the foreign currency, whatever call it. Now, if like I say, if the transactions happen in U.S. dollars, you don't have to do any of this. If they're going to pay you in U.S. dollars, and a lot of times that you'll have that. So yeah, it makes a difference whether if it's in U.S. dollars, even if you're selling it, you're exporting it to somebody else or buying it from somebody else. If it's in U.S. dollars, it doesn't matter. But if it's in their local currency, then you do have to do this. I was buying I kind of restore older motorcycles, and I found some of these parts that are in coming from China or Japan and stuff, that Thailand. Anyway, I noticed that, like, if you do the translation into Canadian dollars, that it was actually cheaper to buy them, pay them in Canadian dollars, do the translation, and then get the parts cheaper. So it worked a few times, and then the time I stopped doing that, they actually sent the stuff to Canada. So it's like, okay, I guess I'm not so smart. I try to save like $3 or something, and it's in Canada somewhere. Okay, now there are ways to hedge these foreign currency changes. A lot of times you're running a business, and businesses, they don't like unknowns, and you don't want to have your whether it goes swings up or down and all that kind of stuff in the foreign currency market. So a lot of times they'll say, okay, I just want to lock in at this price, whatever the price is. We can lock in at that price. Okay, so a lot of times what they'll use is derivatives. Derivatives are something that gets their value from something else. For instance, an option to buy Canadian dollars, the option itself gets its value from whatever the value of Canadian dollars are. So let's just kind of go through what a derivative is, and then these are what they will oftentimes use to lock in a price. So they say, look, I don't want to have the rupee go up or down or whatever and lose money, and we just want to know what we sell it for and all that. Now, there is a kind of a caution, though, in that a lot of times people don't understand the derivatives, and something like 10% of derivative supposedly hedges do just the opposite. They add more risk. So there is a problem of sometimes the hedge is done incorrectly. Also, sometimes people increase their risk by dealing in these derivatives. So if you're just dealing in derivatives, it's more like an investment if you're not trying to hedge a transaction. So I got this transaction for selling something in India. There's a legitimate reason for me to be trying to hedge that with some kind of an option or derivative. However, it could also just be that I'm speculative. I say, okay, I think that the rupee is going to go up or down or whatever it's going to do, and I can make money on that by trading in these derivatives. So sometimes it's an investment, sometimes it is there for a specific purpose of bringing stability to the business, so that you don't have these big translation swings up and down. Okay, so derivatives get their name because their value is derived from something else. Okay, example would be a coupon. So someone has a coupon to buy a new phone for $100. The value of that coupon depends on the price of the phone. Okay, so if the new phone regularly costs $137, then the value of the coupon is 37. Right. So the value of that coupon depends on, it's derived from whatever the price is of that new phone. So if you can buy the new phone for $100, I got a coupon. It depends on the price of the phone. So the phone costs $137 and the coupon's worth $37. You're gonna save $37, that's the value of the coupon. Now notice if the phone is only worth $88, then the coupon is worthless. No one would want to use a coupon to pay $100 for an $88 phone. So the value of the coupon, you know, buying the new phone for $100, it depends on, it's derived from the cost of the new phone. So that's all a derivative is. It just means the value is derived from something else. You know, the coupon itself, you know, is negligible value, a piece of paper, but the value is derived from the cost of the phone. It might be worthless. It might be worth, you know, $37 or whatever, but its value is derived from something else. Okay, so commonly used derivatives. Future contracts. Future contract, they must buy or sell something at a specified price. This could be goods, it could be currency, anything that you would have to buy or sell something at a specified price. So for instance, the contract might say that you must buy 100,000 euros at $105 each. And whoever's on the other end of that contract will expect you to buy 100,000 euros at $105 each. Now, the euros might be worth $103 each. They might be worth $110 each. But this contract says you must buy them at 105. These contracts are often bought back rather than fulfilled, especially for things like corn. You know, people invest in corn futures and stuff like that, and you know they may buy 300 million, you know, whatever bushels of corn, and they don't want the corn. They're just dealing in the derivatives. I used to work, by the way, at the Chicago Board of Options Exchange. I worked there for a little while, doing stock options. But anyway, you know, so a lot of times these contracts, even though they are for specific things, there is a market for them. And sometimes, you know, a lot of times you can buy them back. The contracts will have a specific price and they can be bought back at that price. Okay. Option contracts. Option contracts are, they give you the option. I don't know why I have half of a thing here. So there's an option that you may buy euros at $105 each. Okay. So this gives you the option of buying them or not. They give you the right without the obligation. So if the euros are, you know, if the price of the euro is more than $105, you probably use this. You know, let's say euros are 110. Well, you can buy them for 105. You know, do that. But if the euros are at, say, 99 cents, well, you don't want to pay $1.05 for euros that are only worth 99 cents. You just want to use the option. So futures contracts and options contracts are two commonly used derivatives. And they can be used for many different things. You can use for stocks, they can use for currencies, they can use for bonds, all kinds of things. Some people mistakenly think that options, you know, because you don't have to buy or sell, that they have a much lower risk. But oftentimes options are all or nothing, kind of like the coupon. the coupon might be worth $37, it might be worth zero. Now notice that if your investments, if you keep, investing in these, and these things have a lifetime of, whether it's 90 days or whatever it is. If at a certain point, if there is a probability that at some point some of these are gonna be worth it, you could actually lose all your money. 100% loss, rather than, oh gee, the stock went down 10%. So you'll see people that, because they think, okay, I don't have to go through with the option, that this is less risky. But quite honestly, they can be very risky, because a lot of times it is all or nothing. Either you make a gain on it, a pretty good gain, or it's worth zero. And just like at gambling, if you do that enough, a zero is going to come up at some point. There are people that do it for a living that are smart at doing it, but it's not for the everyday person. Okay. So derivatives can increase or decrease risk, and it makes a difference in how you do it. So to be a hedge, to actually be a legitimate hedge, that I have this business deal that I want to lower the risk, I want to lock in a price, bring stability to this transaction. It has to basically have three conditions. It has to, and these are the two methods they use here, is we're not going to get into the details on these, but there's either the fair value method or the cash flow method. So either it protects your fair value or the cash flow. That it actually does what it's supposed to do. It actually needs to offset the risk. So there has to be something that it offsets. So if I buy rupees and I don't have a contract in rupees, that is not offsetting anything. At that point, that becomes an investment. Derivative properly documented as a hedge. In other words, it's for a specific transaction that has happened, or transactions, it could be more than one, but that it is documenting what it is actually offsetting. It can't just be generally offsetting, oh, we have business in India. It has to be specific to that it's actually offsetting a specific transaction or transactions. So all three of those have to be in. Now, you say, well, what if it doesn't? That's not a problem, but you're going to count it as an investment. You're not going to count that as a true hedge, which is to reduce your risk. So you can actually reduce risk or increase risk with derivatives. So for that reason, they are it is tricky, because it sometimes, and again, I think I told you that even large companies a lot of times will do them incorrectly. They'll end up with the wrong end of the deal when they do the actual derivatives. They'll be doubling down on their risk. So if the price of the rupee goes up, it double goes up. Because they did the hedge wrong. Okay, I think. I got homework I want to assign you guys, but I just want to make sure that we have the same the same problems, because my book is goofed up. And the problems I want to assign are particular problems 11 and 12 at the back of chapter 6. As if someone could pull up on there, I just want to make sure that you have same thing that I do. It looks like it would be on page 269. You'll notice I got these wacky numbers. Goes from 33 to 38 to 43. And I think it's this one. I think this, my 43, I think is your number 11. Garden Grove Corporation.
Yeah, that's what it looks like in my book.
Okay. So number 11 would be Garden Grove. And I think this number 1 down here is actually number 12 on yours. El Primero.
Yeah, it's the same.
Okay. So I'll let you guys go ahead and do that. I won't keep you guys here for this. But anyway, you can do these on your own. And I put a drop in there. But this is basically similar to oh, don't do that. This is similar to the year-end ones. You know, it's similar to those year-end ones. So problems 11 and 12. I'm gonna put the page on there. I think is it page
Yeah, it's page 269.
269. Okay. Okay, I also sent in the email just recently journal entries for textbooks. You don't have to use those, but if you want to, you can use those to enter those problems. You know, and you can do calculations in the rows too. So if you want to use that, yeah, feel free to, or if you want to do, you know, a notebook paper or however you want to do it is fine. Okay, so we'll go ahead and assign those. So textbook problems 11 and 12. And those will be due on, I think I got them for October 7th. And then that way, if you have any questions on the next class, we can go over them. Stop here. 14. Orlando. And Paulina. Okay. And call it a night, and I will see you next week. Next week, we'll go over any problems, any questions you have on the homework. And then we'll also start in on chapter 7.